Hello and welcome to this video on the impact of Benjamin Graham on Warren Buffett's investing style. In this video, we will explore the life and work of Benjamin Graham, who is considered the father of value investing. We will also look at how his investment philosophy influenced Warren Buffett's approach to investing, and the lessons we can learn from these two great investors. Who is Benjamin Graham? Benjamin Graham was born in London in 1894, and his family moved to New York when he was a child. He went on to study at Columbia University, where he eventually became a professor of finance. Graham is best known for his work as an investor and author. In 1934, he wrote a book called Security Analysis, which became a Bible for value investors. In this book, he laid out the principles of value investing, which focused on finding companies that were undervalued by the market and had a margin of safety. Graham's investment philosophy. Graham's investment philosophy was based on the idea that the stock market was often irrational and that investors could take advantage of this irrationality by buying undervalued stocks. Graham believed in analyzing a company's financial statements and balance sheet to determine its intrinsic value. He also looked for companies with a margin of safety, which meant that the company's assets were worth more than the market value of its stock. Graham's impact on Buffett. Warren Buffett was first introduced to Benjamin Graham's investment philosophy while studying at Columbia University. Graham's emphasis on finding undervalued stocks and investing with a margin of safety resonated with Buffett and formed the basis of his investing style. After graduating, Buffett worked for Graham's investment partnership, where he learned firsthand about Graham's approach to investing. However, over time, Buffett refined and adapted Graham's approach to better suit his own style and the changing investing landscape. One key way that Buffett modified Graham's approach was by focusing on the quality of the underlying business, not just the price of its stock. Graham saw stocks as mere pieces of paper to be bought and sold, but Buffett recognized that the underlying businesses were the real source of value. Buffett also placed more emphasis on long-term thinking than Graham did. While Graham focused on buying undervalued stocks and selling them when they reached fair value, Buffett sought out high-quality companies with sustainable competitive advantages that he could hold for years or even decades. Another way that Buffett diverged from Graham was by incorporating ideas from other disciplines, such as psychology and behavioral economics. He recognized that market irrationality could create opportunities for savvy investors, and he sought to take advantage of these opportunities by buying stocks that were undervalued due to short-term market fluctuations. Despite these modifications, however, Buffett still credits Graham as his primary influence and mentor. He has said that Graham's teachings about value investing and margin of safety are the cornerstones of his investing philosophy, and that he owes much of his success to the lessons he learned from Graham. Lessons we can learn. 1. Have a solid investment philosophy based on sound principles. Benjamin Graham's investment philosophy was based on the idea that the stock market was often irrational and that investors could take advantage of this irrationality by buying undervalued stocks. Graham believed in analyzing a company's financial statements and balance sheet to determine its intrinsic value. By following this approach, Graham was able to find undervalued companies with a margin of safety. Similarly, Warren Buffett's investment philosophy is based on finding high-quality companies with sustainable competitive advantages and investing in them for the long term. The lesson we can learn from these two great investors is that having a solid investment philosophy based on sound principles is key to successful investing. Whether you're a value investor like Graham or a growth investor like Buffett, having a clear and consistent approach to investing is crucial. 2. Discipline and patience are essential. Both Graham and Buffett emphasized the importance of discipline and patience in investing. Graham believed that investing was a long-term process that required patience and a cool head, while Buffett famously said that his favorite holding period was forever. The lesson we can learn from these two great investors is that successful investing requires discipline and patience. It's important to stay focused on your investment goals and not get swayed by short-term market fluctuations. By staying disciplined and patient, you can weather market ups and downs and achieve long-term success. 3. Analyze a company's financial statements and balance sheet. Benjamin Graham's approach to investing was based on a rigorous analysis of a company's financial statements and balance sheet. He believed that by looking at a company's financials, he could determine its intrinsic value and find undervalued stocks with a margin of safety. The lesson we can learn from Graham's approach is that analyzing a company's financial statements and balance sheet is essential to successful investing. By understanding a company's financials, you can assess its underlying value and make informed investment decisions. 4. Have a margin of safety. One of the key principles of Benjamin Graham's investment philosophy was the importance of having a margin of safety. Graham believed that investors should only buy stocks that were undervalued by the market and had a margin of safety. The lesson we can learn from this principle is that having a margin of safety is essential to successful investing. By buying stocks with a margin of safety, you can protect yourself from downside risk and increase your chances of success. In conclusion, Benjamin Graham's impact on Warren Buffett's investing style was profound. While Buffett adapted and refined Graham's approach to better suit his own needs and the changing investing landscape, he still considers Graham to be his primary influence and mentor. By learning from the lessons of these two great investors, we can better understand the principles of value investing and how to apply them to our own investing strategies.